driven by massive tech valuations, artificial intelligence booms, and the constant hum of digital assets. But while retail investors are chasing that momentum, the world's billionaires and central banks are looking entirely in the opposite direction. Behind the scenes, these massive financial institutions are quietly stockpiling record amounts of physical gold. On paper, this makes very little sense. Modern portfolios are built on growth and yield. Gold doesn't produce quarterly earnings, it doesn't pay a dividend, and it certainly doesn't generate revenue like a tech giant does. Yet these institutions aren't buying it to generate a profit. They are buying it as an insurance policy. They see vulnerabilities in the global system that most everyday investors are currently ignoring. When the people who control the money supply start aggressively hoarding the world's oldest asset, it is a warning sign. It tells us that underneath the market euphoria, there is serious structural risk. To understand that risk, we have to look at how modern fiat currency actually works. When a government needs more money to fund its operations, it can simply authorize a central bank to create it. It is an endless mechanism. But creating new units of currency dilutes the value of the units that already exist. Over the last few years, we have watched global sovereign debt climb to astronomical levels, heavily supported by aggressive money printing. This chart shows the direct result. That declining line is fiat purchasing power, constantly eaten away by inflation. Inflation acts as a quiet tax on wealth, penalizing anyone holding cash, while the horizontal line, gold, holds its ground. The reason gold holds its ground is mathematically straightforward. It cannot be printed, downloaded, or manufactured on demand. Its supply is strictly bound by physics. When citizens and governments lose faith in paper money, they invariably seek safety in physical assets. Capital reliably retreats to something that governments cannot artificially dilute. At the same time, we have a stock market operating at maximum velocity. Trillions of dollars have poured into the technology sector, heavily concentrated around artificial intelligence. Markets driven by this level of momentum carry a distinct risk. If we look at historical cycles, periods of euphoric asset buying frequently outpace the actual economic reality, leading to steep corrections. To protect themselves, large-scale investors are skimming the profits off those volatile tech surges. They are taking their high-risk gains and locking them away in stable, physical reserves. They know gold isn't going to double in price overnight like a tech startup. They are deploying it as a parachute. It is a calculated buffer designed to absorb the impact when the market's momentum finally stalls. There is an even larger geopolitical pressure at play. For decades, the global financial system has relied entirely on the US dollar as its undisputed anchor for international trade. But carrying massive federal debt loads and continuously expanding the money supply has consequences abroad. Foreign trade partners are beginning to question the long-term mathematical stability of holding their wealth in American paper. This has triggered a deliberate shift known as de-dollarization. Entire nations are actively looking for ways to decouple their economies from U.S. financial infrastructure. You can see the evidence directly on central bank balance sheets. Instead of buying U.S. Treasury bonds, massive foreign banks are systematically replacing their dollar reserves with tons of physical gold. Escalating international conflicts have only accelerated this process. When nations fear economic sanctions or asset freezes, they immediately move their capital into an asset that no Western power can digitally confiscate. This coordinated international accumulation of metal is essentially a quiet financial rebellion. It is sovereign nations building a protective shield against what they view as a structurally declining US dollar. So, looking at all these macro pressures, how should an individual investor react? Does this mean you need to liquidate your portfolio, clear out your bank account, and hoard physical metal in your basement? Not exactly. Gold isn't immune to market mechanics. Its price still fluctuates daily, and buying in at the wrong time can still result in short-term losses. Its real value lies in deep diversification. Experienced investors use a percentage of gold to anchor their portfolios, ensuring they have an asset that retains their purchasing power when everything else is behaving erratically. The goal is to zoom out. Survival in modern finance requires understanding the broader economic cycles, rather than simply chasing whichever asset had the highest return yesterday. The sheer volume of gold currently flowing into central bank vaults tells us that the major players are preparing for turbulence. We are entering a highly fragile economic phase. Ultimately, by the time financial fear reaches the general public, the smart money has already built its shelter. The time to reinforce your financial structure is long before the storm arrives.